Imagine profiting from other people's debt, not by lending money, but by buying up old, unpaid bills for pennies on the dollar, then helping people pay them back. That's the business model behind Jefferson Capital, a collections company that's about to go public and could offer investors a surprising new way to cash in as consumers across America wrestle with rising bills and financial stress. Let's break down what makes this IPO so interesting and why it's coming at a moment when more and more people are struggling to keep up with their debts. Jefferson Capital isn't your typical lender or credit card company. Instead, they operate behind the scenes in a part of the financial world that most people rarely think about: collections. Here's how it works. Banks, credit card companies, and other lenders end up with accounts that have gone unpaid for a long time. Rather than chasing down these debts themselves, many of them sell the rights to collect on those debts to companies like Jefferson Capital, usually for a fraction of the original amount owed. Let's say a bank has $1,000 in unpaid credit card debt from a customer who hasn't made payments in months. That debt might be sold for just $100 or $200 to Jefferson Capital. From there, Jefferson Capital reaches out to the debtor, but instead of taking a hard-nosed, aggressive approach, they say they work based on the consumer's current financial circumstances. That might mean setting up a payment plan, reducing interest rates, or even knocking down the total amount owed. Their goal is to recover as much as they can while giving people a chance to get back on their feet. Now, you might be wondering, why is Jefferson Capital choosing to go public right now? There's actually a larger trend at play. Americans are racking up more debt than ever before. According to the Federal Reserve, total household debt in the U.S. recently topped $17 trillion, with credit card balances alone reaching over $1 trillion for the first time. On top of that, delinquency rates, meaning people falling behind on their payments, are starting to climb after being at historic lows during the pandemic, when government stimulus and forbearance programs gave people some breathing room. But as those programs have ended and the cost of living continues to rise, more consumers are feeling squeezed. Higher interest rates mean bigger monthly payments for anyone carrying a balance, and inflation has made everything from groceries to gas more expensive. For companies like Jefferson Capital, that means a growing pool of distressed debt to buy and potentially more opportunities to turn a profit. What sets Jefferson Capital apart from some of the more notorious collections agencies is its approach. The company emphasizes working out solutions that fit people's budgets, instead of resorting to constant phone calls or legal threats. In fact, the collections industry as a whole has been under pressure to reform its image and practices in recent years. The Consumer Financial Protection Bureau has cracked down on abusive tactics, and new rules now limit how often collectors can contact debtors or what kind of language they can use. For Jefferson Capital, this softer approach isn't just good PR, it's also good business, because they're more likely to recover money if consumers are willing and able to pay. So, what does this mean for investors? When Jefferson Capital goes public, you'll be able to buy shares in a business that makes its money by scooping up bad debts, negotiating repayment, and pocketing the difference. The company's profit comes from the gap between what they pay for these old accounts and what they can collect over time. It's a high-risk, high-reward business. There's always a chance that a lot of those debts never get paid at all, especially if the economy takes a turn for the worse. But when done right, the returns can be impressive. Historically, the collections industry has done well during periods of economic stress. When unemployment rises or the cost of borrowing goes up, more people fall behind on their bills, and more debt ends up getting sold to companies like Jefferson Capital. In the aftermath of the 2008 financial crisis, for example, collections firms saw a boom as lenders offloaded huge amounts of delinquent debt. We're not in a financial crisis right now, but the cracks are starting to show for many households, and that could make this a lucrative moment for the collections business. Of course, investing in a company like Jefferson Capital isn't without controversy. Some critics argue that profiting from other people's financial hardship raises ethical questions, even if the company tries to work with debtors in a more compassionate way. Others point out that collections are a necessary part of the credit system. If lenders couldn't recover at least some of their losses, it would be even harder for people to get loans in the first place. There's also the question of long-term sustainability. If the economy improves and fewer people fall behind on their bills, Jefferson Capital might find it harder to buy distressed debt at attractive prices. On the other hand, if the economic pain deepens, more debt could be available. But collecting on it could become riskier, especially if unemployment spikes or consumers simply don't have the money to pay anything back. It's a delicate balance, and one that investors will need to weigh carefully. All in all, Jefferson Capital's IPO is a reminder that the world of finance is full of unexpected ways to make or lose money, especially in times of economic uncertainty. Whether this collections company becomes a Wall Street darling or faces tough challenges ahead will depend not just on shifting financial tides, but on how well it can walk the line between profit and compassion. For investors, it's a chance to bet on the business of giving second chances, at a time when millions of Americans could use one. As always, the biggest opportunities and the biggest risks often show up where you least expect them. So as Jefferson Capital steps into the spotlight, it's worth asking, in a world full of debt, will helping people get back on track turn into a winning investment? Or is this a gamble that might not pay off? Only time will tell.